Today we have Shoemaker here to present on navigating the shifting tides of estate planning. Lots of good content around that. We have with us Dave Rechtenwald, though many of you know. I've seen a lot of you pop up and give a handshake there. Nick Linares and Jack Kelly. Just a reminder, we are recording this, so we will post it online, post it to our YouTube page, so you can go back and refer to it at any point, or feel free to share it with a colleague, right? And then with that, I will pass it on over to you.
Okay, thanks, Angie. Morning, everyone. Pleasure to be here. Just looking at my picture. That was taken a couple of months ago. So it's been a rough couple of months for me. And who knew therapy was going to cost so much, right? Nick is a new partner with us as of this year. He'll be speaking today a little bit on retirement planning. And Jack is one of our associates in our department, and he'll be in and out through the whole presentation. Okay, so Nick and Jack and I, bunch of lawyers, we're trying to figure out what we should call this, and we came up with a clever title of changes. And then Megan, of course, who's a marketing major, came up with this topic, navigating the shifting tides of estate planning. And I think that's just evidence that you don't want to have lawyers do any marketing for you at all, ever. So the changes that we're going to talk about is really threefold. One is the stuff that's already passed, okay? Recent changes, and then stuff that's on the books that's pending. Namely the sunset. Hopefully you guys have been acclimated a little bit to the sunset, and then possible future pending changes. And the first one that's going to be stuff that's kind of passed is the retirement stuff. I'm going to let Nick talk about that, but that's on the books, that's passed, and it's kind of a hot topic. And I know we can spend a long time talking about this. It's complicated, but I think you will enjoy these few slides because they're very condensed and kind of cut right to the chase. Nick, why don't you start us off? Yeah, sure. And hopefully this works.
Thank you. So I'm glad Dave mentioned our clever name changes. It's actually a backronym. It stands for something much more clever, similar to the Secure Act, which is the Setting Every Community Up for Retirement Enhancement Act. Because it sounds good to say secure and the actual name is irrelevant. So the Secure Act was passed in December of 2019. The big thing that it did that you heard about, there's a few, but one of the big things it did was raise the beginning date, the required beginning date that you would have to start taking required minimum distributions, RMDs, from 70.5 to 72. And that was later changed, which we'll get to in a minute, by a different act with another great name. And it eliminated the age or threshold of 70.5 to make contributions to your IRA. Previously, a working individual that was 71 could no longer make contributions to their IRA. That's been uncapped. So now if you're working at 95 years old, you can keep stowing it away. Another good thing that came of the Secure Act is an allowance of 529 plans to partially repay student loans. There's a cap on that of $10,000 per student. But if you have excess funds in your 529, you can use that to pay a beneficiary's student loans instead of paying their current college obligations. The bad part of the Secure Act, and probably the part that appropriately got the most press, is that it killed the lifetime stretch. So prior to Secure, an individual could leave their 401k or IRA to a beneficiary, and that beneficiary could then stretch that IRA over their own individual life expectancy. So if somebody named a 21-year-old person as the beneficiary of their IRA, that 21-year-old person might have 75 years to withdraw the funds from that IRA, taking the first year 175th, the second year 74th, and so on until it's depleted. Secure Act, with a few exceptions, said from now on, for people, there's a 10-year rule. You have to withdraw all assets of the IRA within 10 years of the death of the participant. We'll get into some of the exceptions in a moment. And there's still a default rule for non-people. So if you leave your IRA to a non-eligible trust or a charity, then that entity has just 10 years to withdraw, or sorry, excuse me, 5 years to withdraw all of those assets. So that's still the default rule. To kind of accomplish some of the changes they did, they created some new classes of beneficiaries. Primarily eligible designated beneficiaries, which is added as a class. Eligible designated beneficiaries. So these are the individuals that are still able to utilize their own life expectancy, at least partially, to calculate a stretch period on an IRA or 401k, are your surviving spouse. So you still have the option to name your spouse as a beneficiary of an IRA, and your spouse has the option to roll it into their own IRA or establish a new IRA and use their own life expectancy to calculate how long they have to stretch that out. The minor children of an account owner is another group of eligible designated beneficiaries. There's a few rules to that, and one being minor, that varies by state law, which they clarified later and we'll get to, but it has to be children of the account owner themselves. So the previous employee who named their grandchildren instead of their children because they're going to get 50 years more stretch, might want to reconsider that because it doesn't include minor grandchildren of the account holder. And at the age, once that child reaches the age of majority, 21, they have 10 years from that point to get it out. So it's a lifetime stretch until age 21 and then 10 years. Disabled and chronically ill individuals, another thing they failed to define in the original act, but if you leave a IRA to a special needs individual, then they can affect a lifetime stretch and pull it out piecemeal over time based on their own life expectancies. And the last one, and not too common, would be an individual not more than 10 years younger. So maybe somebody names a younger sibling as a beneficiary, then that person, as long as they're not more than 10 years younger, can utilize the old pre-secure stretch rules. Other than that, you get 10 years. And this 0.7 here says they're going to get that lifetime stretch except for what the minor children who would, upon reaching the age of majority, have 10 years. So then there was a lot of ambiguity with the Secure Act. So that, we were excited to hear that Secure Act 2.0 was coming out. We weren't excited once we read it and found it addressed none of the ambiguity of the Secure Act, but it also had the same great name. They just added 2.0 on the end. That raised the RMDs from 72 to 73. And then there's going to be another raise to 75 in 2033. So you don't have to begin taking RMDs until age 73. Previously, if you were due to take a required minimum distribution and failed to do so, then there's a penalty of 50% of the amount that you didn't take out. Plus you go tax on that. So really it'd be a hefty penalty for a lot of people. They realized that was a bit harsh and cut that back to 25% for everybody. And if you correct the failure to take the RMD within 2 years and file the appropriate forms, then it can go down to 10%. So they really reduced a serious penalty. For individuals with IRAs, there's a $1,000 catch-up contribution that you're eligible to make after you reach age 50. For IRAs, that $1,000 has been adjusted for inflation, so it's going to start going up starting in 2024 for every year. And for 401ks, there's a $7,500 contribution, additional contribution that you can make once you reach age 50. For ages 60 to 63, they're increasing that amount to $10,000 or 150% of whatever that current standard rate is, which is $7,500 now. So there's a few years where you're going to get an extra, $2,500 of catch-up contributions that you can make per year. The Secure Act 2.0 also indexed an annual qualified charitable distribution to match inflation. So currently, if you are charitably inclined, instead of withdrawing out amounts from your 401k, maybe to satisfy your RMD, and then donating those and taking a charitable deduction, you can make a qualified charitable distribution directly to the charity, so you never have to recognize that income. And that's a huge benefit, and you can do it annually. And they've also allowed any individual a one-time rollover of, the same as a QCD, but to a charitable remainder trust or to a charitable gift annuity as part of their annual QCD if they choose to do so. That's pretty helpful if that's, again, something that people are inclined to do. So realizing that Secure Act 1.0 and Secure Act 2.0 had a lot of gaps. Secure Act proposed regs came out and we said, finally, we're gonna get some clarity. There's still proposed regs, and I know, Dave, there's some proposed regs that have been on the books for how long now? And they're 20-year-old
Oh, yeah.
proposed
And
regs.
the
that have
tax
never-
code you're talking about?
Yeah, that have never been finalized, so we don't have definite answers, but we have some answers. One thing that was confusing was the 10-year rule for a beneficiary inheriting IRA. We weren't sure if they were going to be required to take some amount annually, 1/10 annually, or none annually until year 10, and then a lump sum. It wasn't clear. So the regulations propose that if you pass away before you're reaching of age 73 or 72, depending on when you pass, then your beneficiary will not have a required minimum distribution until the end of year 10. However, if you pass away after you begin taking your required minimum distribution, then your participant is going to be required to take a annual RMD based on the old rules for year 1 through 9, but the account must fully be emptied by year 10. So they just made it a little bit complicated, but that's important to note the difference. And they clarified that age 21, notwithstanding what your individual state's law is the age of majority that they're going to use for eligible designated beneficiary who's a child of the decedent. And they prescribed kind of a way to determine whether an individual is disabled or chronically ill. And that's in accordance with a lot of disability law. So now I'm going to look a little bit at Secure Act planning. What can you do or what should you be doing post Secure Act? Prior to, as I discussed earlier, Secure, a lot of people would name their grandchildren or youngest beneficiaries on IRAs because they wanted to maximize that tax benefits. They might have done that despite what they truly intended to do because the tax value, tax savings outweighed gifting that asset. So that's something that needs to be looked at. There's no longer that advantage to gifting it to your grandchild instead of your child because they lose that lifetime stretch. You need to review every trust that might receive retirement assets. First, to make sure that it qualifies as be-through trust to get that 10-year trust treatment. Also, you might look at whether or not you can expand the class of beneficiaries on your trust. For example, if you had one child and that's the beneficiary of your trust and you have $1 million IRA paying into the trust, that child's going to get $1 million or $100,000 plus each year for 10 years and report that all on their own tax return. You might consider expanding your class of beneficiaries to that child and their, let's just say 3 children, so that now you're passing out that $100,000 per year on 4 different tax returns, and each person's income tax is only increased by $25,000, less likely to push them into the next bracket. And then for any eligible designated beneficiary, you're going to need to do some special drafting. Previously, we used something known as the conduit trust that made it easier and possible to treat the underlying trust beneficiary as a designated beneficiary under that law so that they could be eligible for a stretch. That's no longer necessary and often practical anymore. So you want to make sure that you have the best terms in your trust. Roth planning and Roth conversions are very popular right now. We have a lot of people making Roth conversions, anticipating that taxes are going to be higher in the future, that for that participant or that their beneficiaries are gonna be in a higher tax bracket in the future. It's often the case that if, you know, you're not in the top tax bracket already, after you pass away and your IRA assets go to your spouse and they're only eligible to use the individual table or the single tables for taxes, that they're gonna be in a much higher tax bracket, so it may make sense to consider some versions down. Well,
That's
let's
it.
see. So,
I got
anything else to add on
any
that?
questions for Nick on that? One question I had is you might comment about the legal effect of the regs. I mean, can people rely on those? Should they be relying on those on that, especially on that 10-year rule question?
So. Can you rely on them? It's kind of a fairness question. It's a good argument if you are in tax court that this is what your proposed regs say to do and this is what you're telling us to do. And a lot of financial institutions operate under proposed regulations, but technically they're not binding law. You know. So there are scenarios where there is some risk associated with following a proposed reg, but typically I think it's safe.
All right, we're gonna switch gears. Talk a little sunset. So I want to set the table, make sure everybody understands the three transfer taxes: gift, estate, and generation skipping. Gift is a tax on transfer of wealth while you're alive. Estate is tax on transfers at death, right? Generation skipping tax is when you try to get cute and you skip and try to skip a level of estate tax, right? The gift and the estate tax are unified in the sense that if you have a $13 million exemption and you use 10 of it while you're alive, you only have 3 left. You can't kind of double dip your exemptions. So I want to make sure that people understand the broad picture as we whittle down a little bit. There's a 40% tax on that's the current tax rate on non-exempt transfers, so above your exemption amount. As I said, the current exemption is technically $12,920,000. It's indexed for inflation. Because of the high inflation, we got a huge bump in 2023. As I said, the gift and estate taxes are unified. Okay. We have historically high exemption amounts, never been higher in the history of the United States, right? In the year 2000, it was under $1 million. In 2013, when Obama passed, the Obamacare passed, he conceded a higher exemption rate. And then in 2018, Trump doubled it with this 2018 Tax Act. And then it's indexed for inflation, and that leaves us at the $12,920,000. And we know on the books, this is that pending legislation I was talking to you about. We know that's going to be reduced in half. So whatever that index amount is coming up on 1/1/26 gets cut in half. I've estimated it to be, given our inflation rates, to be $8 million. Okay. Rough guess, it's going to be within $500,000 of that, one way or the other. So we're staring at the sunset, and we know that those exemptions will be cut in half, and as a result, many wealthy taxpayers are making gifts. They're using their exemptions now before they lose them. Okay, and I realize we're talking about very wealthy people here. Okay, so that's what we're talking about, is using these gifts, making these gifts now so that you use your exemption. So you zero out your estate tax. That's the goal. We all know you can zero out your estate tax by giving it all to charity. But if you don't want to do that and you want to give it to the family, then you got to be mindful of your exemptions and your estate levels, and make sure at the back end, that's the second step, that you've zeroed it out. Any major gift obviously should be in trust. I can't tell you how many times people tell me they made a $2 or $3 million gift to their children or something. It's not in trust, and then it explodes in value. Now all of a sudden you've left your kids with a huge estate tax problem. Okay, so use trust, people. Another point to make is it's always better to use one spouse's full exemption than half of each. Okay, because you want to use that that portion that's gonna disappear in 2026. You wanna use that amount for at least one person. And here's an example. If you have a couple with a $26 million estate, and they have a $13 million company, again, big estate, right? If they split the gifts and you know, each husband makes 6.5 and of the company, and let's say wife owns half of it, she makes 6.5, they'd have $13 million exemption, $13 million estate left, and then they each have 1.5 left, assuming $8 million exemption that I talked about. They would each have 1.5 for a total of 3 million more in exemption. So that leaves them with a $10 million taxable estate at the 40% bracket. By splitting the gifts, they're going to pay an estate tax of 4 million. And if we just did it a little differently, where one spouse makes that gift and the other spouse doesn't, you still have a $13 million remaining estate, but you have the other spouse's full $8 million. Okay. So you're able to reduce your taxable estate, and then your estate, you're able to cut it in half. Okay. So that's kind of an obvious point, but just make sure that you keep that in mind if you're doing any gifting. So many people can't afford to give away 13 million, right? So what are the tools, what are the trusts that you can use? The go-to, most popular, most flexible, most powerful one is the SLAD, right? Has anybody heard of a SLAD? Okay. Okay. Bob, you've heard of it many times. So we're going to talk about that. And then there's other trusts, especially for unmarried people, that they can use as well. They're not as dynamic or powerful, but they're still very good and better than doing nothing. Okay. So we're going to talk about SLADs. The SLAD is an irrev trust. One spouse sets up for the other. Okay. It usually lasts many generations. And it can be a basket. It can be a receptacle for one spouse's big gift. Okay. The grantor spouse can be the trustee and the beneficiary and can have access. So that's the coolest thing about this is you can make this gift, you get it out of your estate, but you still have access to it and you still control it. You're going to hear that a lot today. Okay. And at death, you can control it because you can, by the terms of the trust, you can give that spouse who's the beneficiary the right to say, hey, I want to specially appoint these assets to anybody, including the grantor spouse. Okay. So that's kind of how a SLAD is composed. It's an irrev trust. Typically, you have the spouse, unless there's a compelling reason not to, usually have the spouse as the trustee and the spouse as the beneficiary. You can get access through that beneficiary spouse. This is the flow chart of it. Okay. You can see that in this case, we had the wife set it up for husband. Husband's a trustee, can vote the stock that's in there, can control distributions, usually you make the kids beneficiaries along with the husband or the spouse. And then, and so at death, if the wife survives, then the husband can appoint the assets back in trust for the wife, okay, who was the grantor. So even though the wife made the gift, years later, she can become a beneficiary. Very legal, very powerful, very flexible. And I guess we'll find out in a couple minutes if Biden plans to shut that down, because Jack's going to talk about that. Okay. So let me back up, sorry. So at the second death there, the assets then get divided. I arbitrarily assume 2 kids. And then because it's the dynasty trust, they have a lot of the same control, same flexibility, but then at their death, it stays in trust for their kids. So that's what the flow chart looks like. Jack, do you want to comment on Trust Advisory Committee? You want me to?
So trust advisory committees are very powerful when there are closely held business interests held in the trust. again, it's important to think about if husband is the trustee and the primary kind of business operator during life, what happens when husband passes away? Who is going to take control of voting the business interests that are still held in the trust? And oftentimes husband wants some close associates or business colleagues to be on this trust advisory committee, typically have an odd number of people to vote those shares or units. Oftentimes, or other times too, you might consider adding the spouse as a member of the advisory committee who can weigh in on certain things, while not having complete control. So these can be built in with a lot of flexibility depending on the client's circumstances. Anything to add about that?
Nope, you're doing fine.
All right. So slats truly are not too good to be true. They're a wonderful planning vehicle, but they do come with certain risks. So one is the loss of the basis step up. As you may know, if you die with assets in your individual estate, subject to estate tax, the federal government allows you at your death, or allows those assets at your death to receive a step up in basis to their current fair market value. When you give assets to a slat, it's no longer part of your individual taxable estate. And so the slat will receive the donor's carryover basis, inheriting again the donor's basis. And again, when the donor dies because those assets are no longer in his or her estate, you've lost the step up. This can be mitigated though, and all these risks that I'll talk about can be oftentimes mitigated by good planning. The way we mitigate this risk for many people is we do upstream basis planning. So what is that? If you have an older parent, for example, with a load of their $13 million estate tax exemption left, you can make them a discretionary income beneficiary of the slat. They don't have to receive a dime, okay? You give them a formula general power of appointment up to their estate tax exemption amount when they pass away. They don't have to have the ability to actually exercise that power of appointment without the consent of a trusted trust protector, for example. And because that formula general power of appointment gives them control over those assets in the slat up to their estate tax exemption amount, they get a step up in basis because of that. So the parent never actually has to see those assets. Those assets can stay in the slat, but you do get a step up in basis at that parent's death, which is a very, very powerful planning tool.
Yeah, I think it's one example. This is a real life example. We've had this benefit. This is a huge benefit. We had somebody who made a gift, $5 million business, had $1 million basis. Okay, we gave the wife, his mother, who's 103 years old, a formula general power of appointment. She died 3 weeks before it went public. So we got a full basis step up to $10 million, and he sold the company for $10 million. So we basically eliminated $9 million of capital gain, okay? Which you could never have done without the slat, okay? So this is turning something that's typically a negative into something that's extremely positive. And you know, it's aggressive, but like I said, we've had a lot of people go through this, and we've had to deal with, even if you have a trust with publicly traded securities, we got to convince people that we deserve a step up, and we've not had anybody deny it.
It's truly having your cake and eating it too, which is great. The second risk that we've identified is an impact on the donor spouse. So if we went back to Dave's flow chart, and the wife sets up a slat for the husband, the wife is making use of her exemption amount, but giving away assets that she would have had control over. And she preserves access to those assets by virtue of being married to her husband, who is the trustee and the primary beneficiary of that trust. What happens if they get divorced? Well, that's a huge risk for the donor spouse, right? Because you've lost access to the assets that you one time had control over. What we try to do to mitigate this risk is provide language that says that slat assets will be considered marital assets in the event of a divorce. So everything will be divided evenly 50-50 if a divorce ever took place. For clients who might have an old slat or who didn't have a provision built in, we can use post-nuptial agreements now in the state of Ohio to mitigate that risk of divorce as well. So I'll touch on that at the end of the slideshow, but that's another powerful planning tool as well. This is a big one: failure to follow required formalities. As a business owner, you might be used to taking distributions out of your company and putting it in your own bank account. If the trustee now, or the trust, the SLAT is now the owner of that business interest, you can't do it that same way. It'll bring it all back into your estate and blow up the entire plan. So we need to make sure that, the formalities of ownership and the formalities of trust distributions, according to the health, education, maintenance, and support standard, are actually being followed through. The way we mitigate this is we schedule an annual checkup with our clients for whom we've drafted SLAT, make sure that they are being administered appropriately. And again, we're not blowing up the entire plan by not, stepping through the right hoops. Finally, there's a risk of an IRS audit. I think you've all heard about the great funding that the IRS has received lately. I think it was 87,000 new agents that they want to hire. So the likelihood of audit might be going up. It would only make sense and only follow. So if the IRS does audit a gift made to a SLAT, they might determine that the value of the gifted assets exceeds the donor's exemption amount. They might take issue with the way that the appraisal is done, for example. If that happened, the donor would be subject to out-of-pocket gift tax. What we do to, again, get around and mitigate this risk is we structure certain gifts as formula gifts, which means if it's a hard to value asset and the IRS attacks the valuation that we initially went with, we say that the amount of the gift that the donor actually made was is reduced to the amount as finally determined for federal estate tax purposes. I don't know if you want to touch on that any more.
Well, I mean, it's complex. It's a deep subject because there's 3 or 4 different formulas and we're constantly watching the IRS and the case law to see, what they're fighting against. But, it's a very powerful way to protect yourself from going over the exemption amount. Nobody wants to think that they have a $10 million company, give it to a trust and then find out it's worth 30. Okay, then all of a sudden you got to pay gift tax on the amount over 13. Okay, so you structure it as a formula again. Another very common thing that we do is structure these so that it's a gift/sale. So it's a gift up to the exemption amount. And then if there is any value finally determined for federal estate tax purposes to exceed 13, then the balance is sold. And you exercise a note from the trust back to the seller. Okay, so that's another way, very common, very popular. Pretty hard to get into right now, but that's a very common way to make sure you're not paying any out of pocket. I found most of my clients don't like to pay 40% out of pocket gift tax.
Yeah, the whole point of these slides is that there are pitfalls of SLAT planning, but we're able to navigate those very well. We have our finger on the pulse of the things, the different landmines that might be out there. I think Dave, you're next in the line change here.
Yeah, so just kind of summarizing what we're talking about and why it's so powerful is, again, one spouse can use the exemptions before the sunset. Okay. The other spouse can control the investments. We haven't really talked about that. It's less of an issue when you're talking about funding this with closely held, but when you're talking about securities or bonds or stuff like that, that is important. But it gives them this ability to make the gift, but still have access to the income and the principal and control where it goes at death. So pretty flexible tool. Here's one. It converts assets that are subject to the couple's creditors into assets that are not. Because these assets in the SLAT are protected from creditors. Okay, so if you sold your business, if you transferred the business into the SLAT, then you sold it and you got a bunch of liquid cash, guess what? All that stuff is now protected from your creditors. Whereas if you didn't do it and you held on to it, it's the first thing the creditor is going to go after. Okay, I'm sorry, but creditor protection is something that we focus on. It's typically not that much of a problem, but boy, when you have the ability to protect someone's assets and they get a creditor problem and then they call you and thank you, it's very rewarding, and that's happened. So it gives even the couple creditor protection, and of course it provides years of asset protection for your issue. It's all exempt from creditors, including divorcing spouses. I find that most of my wives love to hear the fact that their kids are going to be protected upon divorce. I don't know why it's the Y, but it is. So, and then all that future appreciation, okay, all that growth on that 13 million is out, right? It stays out of the system. So it can grow and grow and grow. And I have a question here about if you made a $13 million gift and it's 3 generations of growth at 5%. Keith, you should know this answer. What do you think it's going to grow to in 90 years at 5%? Any guesses? It's going to grow to a little over $1 billion. Okay, 5% net. Okay, net of distributions. Okay, net of tax. Okay, but the net amount is it's just an example of how you get this compounding growth. And when you're not reducing it every generation by a 40% tax, it can really be significant. Okay. Questions on that? Anything? Obviously, for a big estate, some with 26 million or more, a lot of times they'll use 2 trusts. Okay, and we don't really like to have 2 side-by-side slats, husband slat, wife slat. Why? Because this little thing called the reciprocal trust doctrine, which is an IRS tool, they can uncross things that look too much alike and say that the husband is really creating a trust for himself, includable in his estate. Wife is creating a trust for herself, includable in her estate. Okay, so we don't really like to use side-by-side slats, but we know how to do it. We've done it a lot. We know how to make them distinguishable enough not to be reciprocal. Okay. The problem with that is you don't know until the second death whether it worked. Okay, that's one of the reasons I like to use some other trust for the other spouse. Okay. And then for the, let's call it median. It's kind of sad to say that a state between 13 and 26 is median, but for this purpose, let's just say we've used it when you're in that situation, you just use one. You have one big gift. And again, remember what I said at the beginning, we're trying to zero out the estate tax. That's our ultimate goal. So if one spouse makes the full gift and we just need to make sure that the estate stays below the exemption amount of the survivor. Okay. And then even for estates under 13 million, if it's likely to mushroom in value, it's a good idea to get it out before it mushrooms, right? So we're in that situation a lot. And even in number 4, the situation where, you know, you have $3 or $4 million of publicly traded securities, you can get that out and obtain asset protection. Okay, I did that for 2 surgeons and that are married. And so whether or not it provides any estate tax savings or not, who knows? But it provides them a lot of comfort knowing that their assets are protected. Now, maybe one of the biggest things about all of this is number 5. Okay, you can take it for a ride. You set this up, you make your gift, and then if you're still in the growth period, you can have all your new businesses owned by the slat, staying outside the estate, protected from creditors. Okay, we have a lot of clients taking things for spins. Okay, so it's just gives them a basket to have all new ventures owned by. Okay, questions on that? You guys are filled with good questions, by the way. Let's turn over for Nick, who's going to talk about a second option here, not a slat, but another gifting vehicle where you can still enjoy.
Thank you. So, as Dave mentioned, I'm going to talk about asset protection trusts for gifting purposes. There's a whole nother class of asset protection trusts for long-term care planning, maybe, and or high-risk ventures where a doctor might want to set aside some amount of cash, but not for gift and estate tax purposes. What I'm primarily talking about are completed gifts that use some of your estate tax exemption or your gift tax exemption. So in Ohio, we call these asset protection trusts legacy trusts because there's the Legacy Trust Act. I don't think legacy stands for anything. That is in Ohio. What this is a self-settled trust. So I, as the grantor, and gifting assets to a trustee or to a trust to be administered by a trustee for my benefit. It's not for some third party. So that's what makes it a self-settled trust. And this is common or popular for somebody who might not be married, so a slat's simply not an option. Or maybe somebody who's got a spouse they just don't want to risk having reciprocal trust doctrine applied on, or don't want the trust having access to the funds. So it's a kind of a backup option that we use quite often when a slat's not viable for that client. It is popular because an individual can make a gift and still have access to those funds. Whereas with slats, you're giving it away and you only have access through your spouse, maybe. The common structure that we use, and again, this is a completed gift, so we're going to use some of my gift tax amount, is a dynasty trust similar to the slats. They're going to have multi-generational growth. We don't want to waste that opportunity. Oftentimes, the initial trustee will be somebody who is a family member, friend, trusted advisor, attorney. It's not necessary, but it's common. Oftentimes, it's best to have somebody who's truly not related or subordinate. And if the grantor, so the grantor beneficiary has the power to remove and replace that beneficiary or that trustee, then that trustee can only be replaced with somebody who is not related or subordinate. That's one of the rules of the legacy trust statute. One rule is that the trustee has to be an Ohio resident. So that's something that a lot of rules out a lot of people for this, because they may be Florida residents with Ohio assets. For it to be completed, a completed gift, the person funding that trust can't have a special power of appointment, meaning that you can't change the beneficiaries unilaterally. So once you put your assets into this asset protection trust, if your child drives you mad and you're like, I want to kick it down to my grandkids instead, you're stuck. And the trust for completed gift purposes needs to be a wholly discretionary trust. So whoever you're choosing as your trustee, you're giving them full faith that they're gonna use those assets as you wish. There's no health, education, maintenance, and support type standard that you can compel distributions for. Very similar to the slat from here down. But it's pretty simple. You're gonna have your third party trustee in charge, and they can make distributions to the grantor or their issue. There's kind of a hybrid of this called conveniently the hybrid DAP or hybrid domestic asset protection trust, where the grantor is not initially named as the trust or the beneficiary. Some people think that that adds an extra layer of protection from claims that it's kind of a prearranged plan to keep assets in your estate. So, and you'd have a third party that can appoint the grantor as a trust or beneficiary at a later time. It's another option that we've done a few times. So, and that's true with all of our trusts. There's many variations. We're just going over the simplest form today to make it easier. Dave, do you want to go over the comparison?
So just comparing the two, I think it's obvious that the slat's gonna come out ahead. Slat doesn't require an Ohio trustee, but the asset protection trust does, at least in Ohio, okay? You can name the spouse with a slat, the spouse can be the trustee, you can do that really with the asset protection trust. I wouldn't recommend it at all, because I think that's the first thing a creditor will go after is attack you if you name your spouse as the trustee, okay? The slat can have this health, education, maintenance, and support standard. So you know you can get it if you need it for your health, education, maintenance, and support. Whereas with the asset protection trust, it has to be wholly discretionary. Okay, but keep in mind you can always remove and replace the trustee of an asset protection trust. So if you want money and the trustee, the third party trustee says no, then you can say thank you for your service and hire somebody else. Okay, and then you have some execution requirements with the asset protection trust that the slat doesn't have. So again, those are just two options for gifting that we can cover today. There's a slew of other trusts that we could cover, especially if you don't need to have access to the funds, if you want to just set stuff up for your kids, then you can do that. There's several options for that, but we're not gonna get into that. We're just talking about those, if you want to make a gift, use that. You're staring at the sunset and you want to use that exemption, zero out your estate tax and still have access. Jack's gonna talk a little bit about Biden. Yeah.
This last throw business into it, generating it, I'm assuming all the income is gonna be distributed to the beneficiary table. That way the tax, trust is not paying tax.
Most of the splats are grantor trusts. Okay, so the income tax flows right through to you personally. Okay, and so we didn't get into this, but this is a huge plan. The grantor trust valve is my single biggest tool I have to reduce someone's estate tax. Because you put 100% of your business in the slat and all of that income goes, distributions go into that slat, right? But you're responsible for 100% of the tax because the tax liability flows through the slat. So you could use your own assets to pay the income tax on the slat income. Okay, but generally it's a grantor trust, which means you're still paying 100%. Okay, I have one situation. There's several situations where you don't want a grantor trust. I have a guy who's going to sell, he's a New Jersey resident, he's going to sell his business. He didn't want it subject to a 12% New Jersey tax. And so he didn't make it, it's a non-grantor trust. Anything else? Yeah.
Two quick questions. So how long have slat trusts been around?
That's a good question. At least 23 years. I mean, really late 90s is when they started picking up steam, and you had people doing these sales to when the exemption was so low. What they were doing is making a gift of 600,000 and then selling the rest. Okay, because it's a grantor trust, there's no income tax realization of that, right? So they've been doing that since late 90s. Okay, and I got to tell you, we have done a lot of these. Okay, and I have not had one client be sorry they did. Okay, even when in the 2010, when the exemption was unlimited and we didn't know, we thought it was going to fall back, and it didn't fall back because we did a slew of these in that time period, 2010 to 2012. And then since 2018, we've just been busting doing these things. It's just pretty much all I do. Getting these things out. And then what's so cool about this is, they'll put a profits interest in, it's worth, $10. And then 10 years later, it's worth a lot, 100 million.
Yeah. So are these considered irrevocable trusts?
Yes. But irrevocable doesn't mean what it used to mean, okay? And there are ways to amend even an irrevocable trust, several ways.
Be the trustee and.
So yeah, that's not really amending it. That's not really technically amending the trust, but with decantings and private settlement agreements and judicial modifications, we do a lot of changes and sometimes wholesale changes. So it's very flexible. It's flexible now, even these irrev trusts. Anything else?
Are there assets that you cannot put in a slat?
It's a really good question. The only one I really, you don't want to put in something that's going to depreciate, right? You're kind of stupid. But the only one that really causes me concern is the house. And I don't know why, but it's your private house. I don't mind secondary houses, but when you're giving away your primary residence, we have done it. We do it if it's the only, but it's my asset of last choice.
Sometimes land insurance.
Well, yeah, I mean, you can listen, you can use these things as your insurance trust too, right? So if husband's gonna set up a trust for wife, husband can put life insurance on the husband into the trust, right? And get it out of the estate. Okay, so insurance, when you're trying to reduce somebody's taxable estate, you start with insurance. That's the easiest thing to get out of your estate, right? So if you transfer this to a slat, and that slat has a business interest that's producing this revenue stream, Well, you can use part of that revenue stream to pay the premium without using any more generation skipping exemption. It's the way to go. Anything else? Okay, go ahead.
This is the Grim Reaper Darth Vader portion of the program. Because we've heard a lot of good news up until this point, and there may be bad news on the horizon, for taxpayers, that is. And there's a lot of people who aren't terribly concerned about the next couple of slides because the GOP is in charge of the House of Representatives. And they might die on the hill of not lowering the estate tax exemption or doing anything that's adverse to wealthy taxpayers. But we all know that there are debt ceiling negotiations going on right now, right? There's gonna be some give and take, and so we're not necessarily expecting any of these Biden plan options to make their way into a budget, but it's possible. So we want to make sure that we're on top of the wave and that, again, we have our finger on the pulse to be aware of these potential changes that might be coming down the pipe. So we've identified the Biden Green Book basically lays out his budgetary priorities. We've identified the list of items that will really affect people in their estate planning. The first is forced gain recognition. So typically gain is going to be realized on the sale of appreciated property. It's not going to be realized when a donor makes a gift of property during life or transfers property through a bequest at death. The Biden plan would change that. So the transfers by gift or on death would be gain realization events subject to a $5 million exclusion per person. It would also affect transfers to or from irrevocable trusts or partnerships. Those would be taxable as gain realization events. This one's interesting. Appreciated assets would be marked to market every 90 years beginning January 1st, 1942. So this means that the value of an asset will be adjusted to reflect its current value for gain recognition purposes every 90 years. So the first possible recognition event would be December 31st, 2032. The gain over 90 years for an asset held in trust usually is not going to be taxed, but it would be if this mark-to-market regime was put into place. A piece of good news for taxpayers is that the tax on family-owned or operated businesses would be deferred until that business is no longer family-owned or operated. So that was a little nugget or peace offering that got tossed the taxpayers' way. You were my plan for this slide on grantor trusts here. So a grantor trust, as Dave said, is our most effective tool for spending down the assets that are still in somebody's taxable estate. And why is that? Well, it's because a grantor trust is a trust in which the grantor or the donor, the gifter of the property, is treated as the owner of the assets inside that trust for income tax purposes, but not for estate tax purposes. So it's the best of both worlds because the income generated by those assets held in the SLAT, for example, is taxable to the donor as an individual, which is oftentimes a lower income tax rate than a trust tax rate, which is a good thing. But then the donor can start spending down his or her taxable estate by paying the income tax liability generated by SLAT assets. The Biden plan would blow this to smithereens, which is terrible news because it effectively destroys grantor trust altogether. Grantor trust also, because the SLAT, for example, is just grantor's alter ego for income tax purposes, allows the taxpayer to sell assets to the trust without recognizing gain. Again, the Biden plan would do away with this. And if grantor continue to pay the trust income, then that's going to be treated as a taxable gift made to the trust. So this is probably one of the scariest slides in this entire program, even though it's so short. Anything to add there?
Just hope it doesn't get passed.
Right. Dave mentioned earlier the generation skipping tax, transfer tax. Currently, donors can allocate their entire GST exemption worth almost $13 million to a dynasty trust and keep a substantial amount of wealth out of the taxable estates of their children, grandchildren, great-great-great-grandchildren. They can keep it out of the transfer tax regime for a very long time, or in some cases like Ohio, where you can opt out of the rule gift perpetuities forever, which is awesome. The Biden plan would provide that the GST exemption only applies to certain transfers. One being gifts made directly to grandchildren or to more remote descendants or to unrelated folks who are in those generations. And it would also only apply to trust distributions to grandchildren or to more remote descendants who were alive at the creation of the trust. So if you had a great grandchild born right after the date after your trust was established, then a distribution to that great grandchild would be taxable at a 40% rate. So that stinks. Again, that's not how it currently is, but it might be on the horizon. What that means is that dynasty trusts really are no longer dynasty trusts. They can no longer protect those assets from the GST tax regime for generations, which is, again, the main purpose of setting those up that way. Some other changes that we identified, right now you can make gifts of $17,000 to any person in a single year. So I could make a gift of $17,000 to each person in this room and not pay a lick of estate tax or gift tax and not tap into my gift tax exemption amount, which is again a great power that I have. If Biden's plan was enacted into law, I would be limited to $50,000 in annual gift, which means I can only make, a gift of 49 grand to Nick and a gift of $1,000 to Dave, and then anything else I chose to give to other people would be taxed, or I would have to tap into my gift tax exemption amount of $13 million. The White House has also proposed a 25% minimum tax on total income, including unrealized capital gains for ultra wealthy folks with wealth over $100 million. And then this one is interesting because we don't know how onerous it's going to be yet, but trusts with an estimated value of over $300,000 or the gross income of over $10,000, which is pretty much any trust that we've ever set up at Shoemaker, would have to report their value annually. So that might involve getting assets appraised every year. You're probably going to run up legal fees in doing this. And so again, it remains to be seen how onerous this will be, but it would have a chilling effect on estate planning for sure. And I think something else to consider. I don't personally believe that any of these are likely to be enacted into law, at least before 2024. But we mentioned Treasury regulations earlier. There have been 4 senators, including Senator Sanders and Senator Warren, who wrote to Janet Yellen saying, hey, the Treasury Department has the ability to issue Treasury regs to maybe enact some of these proposals. We don't have to go through Congress. That would most likely be challenged in the courts, but it's a back-end way of getting these things. And then there have been pieces of legislation that have already been drafted that could be dusted off and thrown into a budget bill, again, as part of some sort of give and take between the Republicans and the Democrats. So the likelihood of these things being enacted, not high, but it shows you what the Democrats' legislative priorities are. So if they retake control of Congress and they have the White House in 2024, the likelihood of these coming down the line, it would be more significant at that point. All right, we'll end on a piece of good news though. Ohio recently got out of the dark ages and passed a law 2 months ago to the date, or it was enacted 2 months ago to the date, that allows spouses to modify or terminate premarital agreements or to enter into a new postnuptial arrangement. Prior to March of this year, Ohio and Iowa were the only 2 states in the union that prohibited postnuptial agreements. So spouses could not contract with one another to change, for example, maybe their rights in each other's estates. Ohio has kind of gotten with the times now, and you're able to execute a valid postnuptial agreement with your spouse by signing a writing that was entered into freely without any sort of fraud or coercion, and includes a full disclosure of both spouses' assets. As we mentioned in a previous slide, this might be helpful for couples who have done SLAP planning and want to define SLAP property as either marital property or property that belongs to either the husband or the wife in the event of a divorce. So again, it's another arrow in our quiver, which is helpful and only provides flexibility, which in our area of law is a good thing.
Good. That's it. Any questions? Any further questions? Because it's lunchtime and anybody wants me to invite me to play golf, I'm available. Just getting it out there.
The question, just you touched on it a couple of times, the hemp stand, I always get confused on that. Is there a go-to place where, because obviously groceries and stuff would fall into that. But I've also heard of like country club memberships or vacations. Is there a go-to place that you can go and say, this is kind of a general, these all qualify under events?
No, there certainly is not. There isn't. It's just the vagueness that produces a lot of litigation between current beneficiaries and remainder beneficiaries, for example. You know, they'll come in, they'll question, why are you making all these distributions for this guy during his whole lifetime? There is no clear guidance or standard, and it's just one of those things that people fight about and get lawsuits about.
That's one of the, with our estate planning, like a next generation. They don't think they like irrevocable trust because they don't ever think they'll be able to spend. So it's be nice to figure out and explain to them, they can still do this.
So I've never had a child or grandchild, once they understand it, object. Okay, they like it. Okay, and two, maybe the biggest takeaway is if someone recommends a slat, and I've had a lot of accountants kill my ideas on these slats, and it's just mind-boggling. But the biggest takeaway is don't ever hesitate to do a slat. I mean, don't be afraid that you're not going to have access to it, or you're not going to control it. It's just silly. It's just silly, especially if you really need to do it for estate tax purposes. All right, anything else? Yeah.
You mentioned earlier about, how you recommending that you don't split kids because of one spouse exemption all the way first. Is there any way to undo it if you end up in a situation? Where you have someone to go through the divorce, you would, and give tax return, potentially get not split sometimes. Or is it, once it's done?
Yeah, I think if it's done, you're done. You're talking about actually splitting a gift, like on the gift tax return, you're splitting the gift?
You're saying your recommendation was not to split the gift, to use up one spouse exemption.
Yeah, and just to be clear, what I was saying, what I really meant to say, I did say split gift, which you can do too, but I'm just saying, rather than having each spouse make their own gifts, okay, have one spouse make a big gift. I didn't really need it in the split gift context, you know what I mean?
What if he's asking, would you do that and then be forced to one person put your thing?
That's the risk of the divorce that we're talking about. And one of the ways to mitigate that risk is, as Jack said, is you have in your slat that if in the event of divorce, because you got to put something in there. You don't have to, but we like to. If there's a divorce, all the assets of the slat and in your estate are considered marital assets. That's a way to. Did you comment on that? And then again, you got post-nups now, okay? Post-nups are available to clarify stuff. So if you don't have a good provision, or you don't like the provision, or there's no provision, you can have a post-nup, okay? And one of the, I don't know if we're ever gonna use post-nups in this context, but one of the best, coolest things is, I have a lot of clients that have one spouse that's Florida, one in Ohio. You know, they're in different states. And if it's Ohio and you want to do a post-nup, you couldn't really figure out if it was going to be legal or not because Ohio prohibited it. Now Ohio authorized them, so you can do those. All right, yes.
I'm sorry, I'm holding something up. You also mentioned about the formula gifts into the slat. Is there any issues if you give the S corp interest into slat and then the IRS comes back later on and determines the value is incorrect, if you get your formula causing you have to sell some, or you mentioned even changing the amount of these shares and potentially get into the trust. What are the actions you have to take? Is there any issue?
Yeah, so never a problem. I mean, we are acutely aware of S corp issues, okay? Because you've got to be mindful of them and you don't want to blow the S. So if you're making a formula gift, what you can do, keep it simple, is you give 13 million to the trust, the rest, anything above that goes back to your spouse. I mean, there's no S problem there. Okay. Anything else? All right, well, thanks guys very much for your attention. Any questions, feel free to reach out anytime to any one of us, okay? And enjoy the rest of the day and weekend and the holiday, okay? Thank you.
All right, well, thank you
Yep.
so much for coming. We will send out the video link, and is it okay if we send out the presentation as well? I think it's
Sure.
really good information
Yeah.
here. So we will send that out to everyone as well. A quick update before we go to lunch. It is a tech cred application month. So if you aren't familiar with Ohio Tech Cred, see me, but it's basically free funding. Doesn't matter what size company you are. It's funding for anything in the technical realm. There's like 200 different categories you can apply to, up to 2,000 per employee, per credential, per application month. You get up to $30,000 actually per company for application month. The programs that we're running that fall under the tech cred realm is AI, how to learn what it is and how to use it to become more efficient in the workplace. We're doing a whole week on Microsoft Office. Each one's an individual credential, Excel, PowerPoint, SharePoint. We are doing our digital marketing one, which is running now. We had to close people out. It was so popular. We're running that again starting in October. Agile project management, we're doing October. I think I have all those. And then we are doing the leadership development. Does not qualify for tech cred, but it is a popular certificate program we do, which will start in September. Again, see me if you have any questions on that.